We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Futures higher ahead of the U.S.-China talks in Switzerland, although we're only looking at gains of a little more than 0.25% now on S&P futures. NASDAQ futures up 0.4%. If we do close out the session in the green, it'll be the third consecutive day of gains after Monday and Tuesday. We're down. You hear the New York Stock Exchange bell. Mark Bristow there. We just had him on the program. The CEO of Barrick Mining Corp ringing the bell. They have a single-letter ticker, which is really a pretty cool deal. B is the ticker there. STRZ ringing the bell at the NASDAQ after a split with Lionsgate. So STARS will trade on the NASDAQ now, and Lionsgate will be LION on the New York Stock Exchange. In terms of the movers ahead of, or I should say, seconds into the session, we're going to look at kind of a mixed picture here. You got Lyft up, but Expedia down.
Yeah, seriously, a mixed picture here. It's still earnings season, as we've been talking about, Matt. Still earnings season. Consumer-facing stocks, Lyft boosting its outlook, now up about 16%. That has been accelerating its gains throughout the morning. Expedia now down almost 12%, accelerating losses throughout the morning. Affirm Holdings now down about 7%. The forecast was disappointing. Of course, that is a barometer of some credit health there, Matt. We will keep an eye, of course. Our team at Bloomberg Technology has an interview with the CEO in the 11 o'clock hour.
All right, we'll be watching that closely. Also, IAG is going to buy, 32 Boeing jets for British Airways, its biggest order to date following yesterday's trade agreement between the U.S. and the U.K. You can see Boeing is only up 1.5%. I was just looking, by the way, at Wolfspeed. You know, this is a chip maker that our producer in London, Dan Curtis, is always paying very close attention to. Right now, Wolfspeed shares are down 23% at the open. So obviously, these AI-related companies are pretty volatile, but a 23% drop for Wolfspeed as a going concern risk spurs many cuts on Wall Street. Maybe that's one we'll talk about throughout the program. Now, Bank of America says the party is over for U.S. equities. Strategist Michael Hartnett says investors were right to rally on optimism on trade deals, but that won't last. Hartnett argues investors will buy the expectation, sell the fact when trade deals are announced. When I was a kid, we used to say, buy the rumor, sell the news. Let's bring in Maria Waitman, head of equity research at State Street Global Markets. So, Maria, first of all, good morning. Great to see you on this Friday. What do you think? I mean, it seems like we fell a little bit too far after Liberation Day. Now we've rallied a little bit too much in expectation on trade deals.
Well, I think I'll be a little bit more optimistic than some of my peers. So for what we see in our indicators, and primarily State Street custodial database, so what investors have done since the start of the year, when we were all super optimistic about U.S. stocks and U.S. exceptionals, they really squared up their positions. So allocations to, say, tech is gone from the highest ever to neutral. Allocation to cyclical defensive trade gone to neutral. Allocation to U.S. dollar gone to neutral. EMFX at benchmark. Risk appetite is all at benchmark. So investors really squared up those positions. So now we're at a level where, okay, market expects kind of a lot of bad news. There are lots of pessimism. All the expectations, all the surveys are very, very negative. So to me, that's kind of that's the rumor that everything is super bad. So to me, the kind of risk reward is a little bit on the upside, given that if we get something that's positive, and then investors can start kind of potentially like rebuilding positions in some areas.
Yeah, the optimism was certainly felt this week, but it's interesting. If you look at the S&P 500, we're on track to really end the week flat. I want to pull up what the components of the S&P 500 look like, because it tells you a little bit where investor sentiment is going, and you really saw a lot of that pain on the week in the healthcare sector. Now, this is the sector where there's still a lot of uncertainty around Trump's tariffs, but other places like consumer discretionary, even energy, financials, we're all up on the week. Maria, does this mean that the healthcare sector might be sold off enough, given that we're kind of still at peak uncertainty for the moment? Does it bode well for everything else?
Yeah, I mean, to me, healthcare is like a tricky one. The healthcare sector is a sector where we see the lowest institutional investor holding. So that's the sector with biggest underweight position. And I fully get there is huge uncertainty. There is regulatory uncertainty in US. There is tariff uncertainty. So lots and lots of risk for the sector. But given how low the positioning is and uncertainty, I mean, we should kind of think about uncertainty as kind of two-way risk. So it can happen or not happen. So kind of probabilistically. And positioning is really, really low. And I mean, healthcare companies, they do have like strong return on equity. They have good cash flow generation. Their margins have come down quite a lot. Now they looks like a stabilized. So to me, that's actually quite decent quality defensive sector. So to me, healthcare looks somewhat interesting. So yeah, no, I wouldn't be that downbeat on healthcare.
When you look, you say all roads still lead to the U.S., and we've seen, so many people move to diversify internationally, Maria. Clearly, you come from overseas, so you have a different universe around you. But aren't you concerned about big issues like debt and deficits? Tax revenue doesn't look like it's going to be very strong. We continue to spend a lot of money. Doge didn't cut nearly as much as anyone expected it was going to, or at least as was promised. Aren't you concerned about the dollar's place globally?
Well, Matt, I live in Italy, so if you're talking about high deficit countries, and well, you can take a page from my book. But no, of course, those issues that you highlighted, the real issues are very concerning. The point I'm making is if there is problem in US, other countries will feel it a lot more. And for whatever kind of challenges we see in US economy, it's still stronger than other countries. And okay, maybe it lost a little bit of a momentum as a gap between where US is in terms of economic growth and the rest of the world is kind of closing a little bit in terms of corporate earnings. Maybe it's closing a little bit, but US is still a lot better and stronger economies than others. I mean, it's only been, 6 months when we saw Germany is in recession and Europe is struggling and ECB is too far behind the curve and governments are not spending. Not a lot has changed in that regard. Okay, sentiment has improved. So yeah, I appreciate your points on US kind of slowing, losing momentum a little bit, and that's reflected in investors. Already reflected in price coming down, investors reducing their positions in US. But what is really interesting, over the last couple of weeks, we began to see investors coming back into US stocks, not bonds and FX, but stocks. That's where we're seeing inflows, particularly in tech sector. Again, like stronger earnings in tech helped. And we're seeing investors kind of dipping their toes back into US.
Maria, real quickly, one more question for you. You mentioned that the risk is mostly to the upside still, but what would change your mind?
We can't wish away the uncertainty, okay? And we can't wish away the kind of policy changes that kind of upset the market. So what I'm saying is that investors have square up positions. They haven't gone underweight. They can, of course, do that. So I think we're kind of living on kind of a little bit on borrowed time, and one tweet, through social posts can upset that sentiment. But to me, that we already have quite a lot of pessimism priced in. If we stay where we are, markets start drifting higher. If we get some positive trade news, we get higher. But obviously, if with negotiations on the weekend will come with nothing and trade war escalates, of course, that would be felt by the market.
Maria Vaitman of Street, we thank you so very much for joining us this morning to end the week. Now let's get a look at some more stocks on the move this hour with Bloomberg's Denitsa Sekova. I know, Denitsa, you're looking, for example, at Cloudflare.
Yes, we're seeing quite a few strong earnings reports and reaction. One is Cloudflare. The stock is up about 9%. It's coming off very strong earnings reports and solid guidance, which obviously has been something that investors have been very worried about. Cloudflare has expanding portfolio of quiet-based security and compute offerings. That's helping. JP Morgan says incremental uncertainty drives prudence in the guidance we're seeing. We are also seeing an interesting reaction by Jefferies. They actually lowered their target based off this earnings report, saying that despite the great revenue beat, the operating margins were only in line with consensus. So obviously the bar is very high. The company is up 25% year to date, so you can imagine why people like Jeffries are more conservative here, but definitely a very strong day and strong year for Cloudflare.
I'm looking at Trade Desk, and I watch this stock pretty closely because my buddy Mark Douglas runs a company called Mountain, and we're always
about
talking about. Well, we're always saying they're about to go public, right? Maybe it's really going to happen now. And actually, the demise of Trade Desk stock this year was really something that made me think they got to push it off. But Trade Desk is doing very well today, up another 22%.
It's doing very well, really one of the strongest days. As you said, the stock is down 40% year to date. It's been under a lot of pressure, but what we're seeing is a pretty strong earnings report, exceeding expectations, which I guess coming into this were not as high. The company said that the volatility in the economy is actually helping. We're seeing all those reshuffles in ad business and streaming that are happening at Google and Apple. And what we're seeing is that Trade Desk is actually potentially benefiting from that. We're seeing a lot of optimism. For example, Wedbush upgraded their targets. A lot of people are happy about the healthy second quarter guidance, about the first quarter results. And of course, they launched some new platforms. They did a lot of investments. So obviously, cheap price, investments, and people are getting optimistic that from here that there is some upside. And today is a pretty good showcase.
I'm anchoring Bloomberg Business Week this afternoon. I'm filling in for Tim Stenivek, who's on like a day off or whatever. And Mark D was supposed to come on with me, but we put out that story this morning, and then he said, no, I can't now. I'm on a plane.
You know what's interesting about this, too? I've got to say, because I know you watch Trade Desk closely, so I was thinking of what to say to you. The fact that they're doing well today is actually a great thing because people were so worried about advertising spending.
Exactly.
You know, another company that's not doing as well today, Monster Beverage.
Yeah.
Something.
Because of you.
I know. I drink a lot of Celsius. But, you know, my question is, it's actually now positive on the morning. But as far as tariffs go, do you think now that companies can, you know, of course costs are going up, but given that a lot of companies are already doing well, is this an excuse, right? I mean, if there are other things going on.
To raise prices?
Exactly.
Right, exactly.
Yeah, for sure.
We're actually seeing some consumer optimism when it comes to Monster. Morgan Stanley raised their target, and they say that they're seeing a lot of enthusiasm from consumer. And what we're seeing with markets and consumer is that things turn sour very quickly. So you can imagine just coming from very depressed levels, small upside in the reports really help. Of course, the stock had a small loss in earlier trading. Now we're seeing it flip, and perhaps the reaction we're seeing from analysts is a reason. The company is up 16% year to date, so even the initial reaction is not really a big thing. But they did indeed talk in their call and their earnings. They talk about global economic uncertainty. They talk about currency pressures and all that. So it is important, but I guess the worst case scenario is not there anymore.
They also have, do you guys watch MotoGP, the Motorcycle World Championship?
No.
What do you think?
Fabio Quartararo, sponsored by Monster, he's having a fantastic comeback.
That's the reason.
In the past few weekends, you know, Franco Morbidelli, Alex Rins. Okay, Denita, thanks so much for joining us. Denita Sakova, they're wrapping up some stocks. Coming up, Pinterest surges as the company's results ease concerns of an advertising slowdown. We'll discuss those results next ahead of our interview with the CEO of Pinterest, Bill Reddy. This is Open Interest.
And it's time now for our top calls, some of the analyst action in focus this morning. And first up, we're looking at Tapestry, getting raised to a buy at Morgan Stanley. The Coach and Kate Spade handbag maker raised its annual outlook again, struggling them off about a weakening consumer. Morgan Stanley called it a positive revision story. And next up, Expedia getting downgraded to a sell at Piper Sandler. Revenues and bookings in the online travel company had missed estimates, and the firm says Expedia's comments around U.S. travel was discouraging and suggests a tough slog from here. And finally, Lyft getting raised to a buy at Goldman. The ride-sharing company is reporting better than expected bookings in the first quarter, and Goldman sees compelling risk-reward for the stock, Matt.
All right, sorry, I got a Ricola. Just finishing a Ricola here. It was a long night at the bar with all the school moms last night. Let's get to Lyft right now. We're joined by Bloomberg Technology co-host Caroline Hyde here on set. Sorry, I had kindergarten orientation.
Oh, it's exhausting.
I had a school board debate. I've had so much school district, and everybody goes to the bar after.
You're living the life.
These events.
I want to be you, Matt.
And take a Lyft home because you don't want to be drinking.
That's the kind of guy you are.
And driving. This company has done, it's obviously far smaller, but much better than its bigger rival.
In many ways. I mean, Uber's numbers were still relatively resilient, but they didn't live up to the expectations, and Uber's stock has soared so far this year. But Lyft is doing really well because it's slightly cheaper. And I think that's what really Mandeep Singh over at Bloomberg Intelligence is signaling out here. They've got a really loyal fan base that is growing. They've now got 24 million users and above. And the people are coming back time and time again because they're a cheaper offering. How long they're able to substantiate that, it seems as though the more products that they unveil, the more they're able to deliver on EBITDA. Their earnings were really resilient here. You're seeing like 79% increase in EBITDA, while revenue grows to about 14%. They're still signaling they're going to be able to do that in the next quarter as well. So resilient consumer, more new products, going abroad as well. They're bringing you a taxi offering. This is a company that's managing to fend off also that activist investor. Engine Capital have dropped their demands for changes at the board because Lyft has managed to acquiesce and say, sure, we're going to buy back more shares. And that's also what's helping pop the stock, I'm sure.
Also popping Pinterest today. I think this is so interesting because a lot of people...
Because you're using it.
I am. I'm using it a lot these days for certain reasons. But, you know, Pinterest actually is seeing large advertisers increasing their share of wallet.
Yeah.
In this economy, people are really watching how advertisers are behaving. Why Pinterest?
Well, it's interesting because they're managing more and more to be personalized when it comes to artificial intelligence. So they're also making the whole use case for an advert and for a marketer that much easier. You saw that with Meta as well. But I think when there's got worries about TikTok, they've been able to really take more and more market share. They're also trying to claim, and they claim it time and time again, when you go to Pinterest, you're looking to buy something. And so there's that much clearer and closer relationship that the advertiser is getting with you as a potential consumer. They're driving up the value because they're getting more people on board. Remember, this is a company that is adding monthly active users and then some. But they're also really managing to be resilient when we were worried about Shein. We were worried about Temu. We were worried about these Chinese retailers pulling back. That's not showing up in this quarter or the quarter that they forecast for. Unlike Snap, which couldn't give us a forecast, they've stuck and given us a forecast, and it looks pretty rosy.
I have been using Pinterest a lot lately as well, by the way, because it's a great way to store recipes.
Oh.
I'm the guy who cooks dinner for the kids every night, so I store all my recipes.
You're
there.
out with the school moms, you're at the school board, you're doing the dinner. Matt, you're a dreamboat.
I was going to say,
what a modern
really
man.
shocked me in the last couple months.
I'm a super dad. I want to talk about Affirm. This company came out with earnings last night, and first of all, a testament to the CFO there in terms of guiding analyst expectations, because they did a perfect job, right? Revenue was bang in line. But they also slightly raised their forecast for earnings and for revenue.
But shares slump. Max Levchin and the CFO must be slightly bemused by why we've got the stock reaction. So are the analysts. In fact, Mizuho saying, look, they're raising their key metrics. This is a knee-jerk stock reaction, and they think it's going to fade. And Evercore is saying, look, underlying trends are really good here from the volume perspective, from the active customer perspective, and overall they're saying, look, maybe this is once again reflecting some lofty expectations. Max Levchin's going to be joining the show a little bit later, and I'm sure he'll talk to the resilient consumer. They're not seeing any pickup in terms of credit issues overall. We're all sat here waiting for the consumer to stop buying, and thus far they're not doing it.
It's interesting. Very excited for that interview. You are still seeing Affirm stock almost 20% on the year. However, Max Levchin doesn't tend to care about the stock.
Oh, funny that. A CEO never cares when they come on telly.
Well, they own
Down
a lot
20%.
of it.
Yeah, if you lose a fifth of the value of your company in, what, we're 5 months into the year? That's tough.
Yeah, but we'll see what he has to say to you, Caroline. We're looking forward to that interview. That is Caroline Hyde. Tune into Bloomberg Technology today. They have a trio of CEOs, Affirm, Lyft, and DraftKings. My favorite is sports betting, Matt.
I know, you have a problem with that. You've got to watch it. It's addictive.
I do. But also here in our next hour on Open Interest, we're going to speak to the Pinterest CEO, Bill Ready.
With Caroline, she's coming back.
With Caroline, she's coming back.
The reason to continue watching
is Bloomberg Open Interest. Now let's shift our attention to Wall Street South. Ken Griffin's Citadel has made a peculiar play in the talent wars being waged among the top asset managers, hedge funds, and banks in global finance, and that's by introducing a 4-year non-compete clause. Let's dive into the details with the reporter who broke the news, Anna Kaiser. It's really interesting to see him do this. He is putting muscle behind lobbying efforts in Florida to get this non-compete clause brought up to 4 years in that state. How are people reacting?
Yeah, some of the criticism of this bill, this is a bill in the Florida legislature. This would become Florida law. It allows non-competes of up to 4 years. And, some of the criticism is that it's just very employer friendly. It would, give a lot of power over the employee in terms of, giving them their job, and then they have to sign a non-compete, which would potentially mean that they couldn't work for up to 4 years after they left if they ever wanted to.
So I saw this initially, Anna, and I was thinking, cool, 4 years of gardening leave. Like, you continue to get paid and you get to just play golf or whatever. But there are some caveats, right? Because it's not all gardening leave, and you don't get your bonus.
Correct. So, yes, it sounds like a very sweet deal, as you say, but the employer is only obligated to pay the salary, and at hedge funds, bonuses can reach into the millions. It can actually make up such a huge percentage of an employee's total compensation. So salaries actually may not might help keep the lights on, but it might not really maintain the lifestyle that you have.
But if you move out of Florida, Anna, can you work for another company? Is this only if you stay in Florida?
I think that would probably be up to courts to debate. What the bill tries to say is that this actually expands beyond Florida, that this would be if your principal place of business is in Florida, this expands basically everywhere. I would imagine that could probably be challenged in court, but that is what the bill says.
It is the most read story for a reason, Anna. Everybody wants to know these details. Fantastic reporting. Thanks so much for joining us. Anna Kaiser there talking about Citadel and potentially some new rules. Coming up the next hour, AQR's Jordan Brooks and Pinterest CEO Bill Reddy. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and coming up, high trade hopes. President Trump floats an 80% tariff on China ahead of crucial talks this weekend. And quant powerhouse AQR is outperforming many of its hedge fund peers. AQR co-head of macro strategies, Jordan Brooks, joins us at the desk. Plus, strong results from Pinterest ease concerns of an advertising slowdown. Bill Reddy, the CEO of Pinterest, joins Open Interest later this hour.
All right, let's get a check out what's going on in markets on this Friday morning after a couple of days of gains. It looks like we're going to tack on a third, although you can never tell this early in the day, right? What comes out on Truth Social, what details come out about China.
It makes you flat on the week.
This makes you flat on the week, but we're back to almost 5,700 on the S&P 500. So the correction scare that was getting corrected itself. The NASDAQ up more than 0.5% right now, and the 10-year yield, although it had come up yesterday, is now down a couple of basis points to 4.35, 4.36. And that's pretty comfortable, isn't it?
Higher on the week. That's what I keep on going to, right? I mean, it's the direction of travel. But you're right. We can take it. We can swallow it. It's comfortable.
Let's talk to Linda Dissel about this. She joins us right now from Federated Hermes, Senior Equity Strategist. And Linda, I'm thinking maybe we went too far down after Liberation Day. The correction was too severe. But have we rallied too far up at this point to expect any sincere gains on, the trade news we're expecting this weekend?
Yeah, well, thank you both very much for having me today. And here we are. It's been a big ride back up. We pretty much erased everything that we lost with Liberation Day, but we're right now I think just under the 200-day moving average. And I think that's a place where it's kind of a standoff place. That's what I keep thinking in my mind is we may be at a standoff right here. And so we may see some consolidation in through here. We're going to start approaching summertime months. We've got a dearth of information in terms of earnings now because we're just completing earnings season. So now we're kind of hanging our hats on deals. And that could take a while.
Speaking of earnings, if you back out and look at the bigger picture, Linda, at the end of last year, everybody coming on this show was like, we're going to have 14% earnings growth next year. And that sounded amazing. Turns out it really was, because we're not looking at double-digit earnings growth. We're expecting, I think, 8% now for 2025. So do expectations for 6,500 or 7,000 have to be brought down to 5,500 or 6,000 for year end?
For sure, and we brought back down our own to now 6,000 for year, and at a moment we thought we might get to 7,500, but you have to admit that the sort of uncertainty that's out there now has caused a lot of people to, slow down their spending. It's certainly caused business leaders to slow down in terms of their business decisions, and spending and hiring. I mean, you're pretty good still now if you're not losing your job, but if you're looking for one, it's super hard out there. And so that's just another one of those standoff situations right now that we didn't foresee as we came into the new year.
I think speaking of earnings season, a lot of investors look to the big tech companies and the resilience of many of them to see if there's a rebound that could be found. But I was looking, Linda, at the Philadelphia Semiconductor Index, one that we had been watching closely through much of last year. This year down almost 10% still. Is this kind of a harbinger of what kind of pain there still is to come when it comes to the technology industry, the AI trade, the things that really drove a lot of the rally to the upside before?
Mm-hmm. Well, definitely the semiconductor industry in amongst all the technology groups is, more of an early cycle play. It's definitely, it's definitely the infrastructure and the hardware there. And it wasn't really, really bid up in through last year with NVIDIA being the poster child for all that. And of course, that's being the biggest name, having come in quite a bit as an aside is really kind of reasonable now for the outlook. So when you look at software companies, and you're just basically looking and seeing are companies spending a pace on their capital expenditures for technology? Is business still pretty good there? And in conjunction with just a slowdown, that's not necessarily a harbinger for a recession. We wouldn't say at all. We would just say that valuations have come back down to more reasonable levels. Coming into the new year, everybody was just really, really bullish. And that was seen in the price to earnings multiples. To
the extent that you're still concerned about the upcoming volatility, are there sectors that still look a little too pricey to you here?
Well, in general, the entire S&P 500 has been brought down in terms of their multiples. I mean, we have some more favored and some less favored ones. You saw a lot of monies in recent weeks just moving out of tech stocks, for example, and moving into the staples sector. Staples is a very defensive sector. Now, we are very much bullish on defensive value stocks, but that particular sector was one that, we really, that the market really ran to, and it's kind of overdone right now. Still, the utilities, which is considered a more defensive area, is one of our overweights right now, and as is the financial sector, another value area.
I wonder, how closely do you watch M&A, Linda, from an investor's perspective, and what do you expect this year? Because this is another issue where coming into, post-November, pre-inauguration, we thought, man, it's going to be a banner year for M&A as President Trump deregulates this market. It doesn't seem to have panned out that way.
Well, unfortunately, yes, because of this uncertainty that's come our way. And one of the catalysts that we at Federated Hermes are looking for to give us that boost over and above that 200-day moving average is some good news on deregulation, that is to say, that could really jumpstart some of this M&A activity that looked like it was going to be done into this year. And, and the IPOs and the like, we may have to go through a sloppy summer, though, before we should see that. But to the extent that the market can get over and above, and boy, to us, what we'd really love to see is some news on a tax cut. And we'd love to see that by July 4th, really.
Further tax cuts, right? Not just an extension of the tax cuts that we're used to.
Well, we need the extension of the tax cuts that we're used to, over and above that would be good. And I think that to get that weight taken off, just the kind of a cliff that you would go over if you did take away, I acknowledge those are not new tax cuts, but that's part of the the big beautiful deal, and maybe some of these other tax cuts that the president's talking about with regard to corporations, with regard to tips, would be very, very bullish, and that would really get the economy, and I think...
Let's not forget salt, Linda. Yeah. President Trump, when he came to New York, promised he would get rid of that salt cap.
We don't talk about that in Pennsylvania.
Well, Linda, we thank you so very much for joining us today. That is Linda Dussel of Federated Hermes. And we are looking at some single stocks this hour as well, because we are watching Tesla rising over 7%. It's the biggest jump, or the highest levels, rather, since we've seen since the end of February. Not to mention, it's on the brink here of moving out of its 200-day moving average as well.
And becoming a trillion-dollar company again. Right now, Tesla is worth $985 billion.
On the brink, like many things. CrowdStrike, though, now down about 2.6%. This is after the U.S. opened an investigation into a deal the company made with a technology distributor. Remember, that is kind of overshadowing some of the other promising earnings. Pinterest, though, we're watching is higher. The company's AI efforts is boosting growth, drawing advertisers. It's on a tear, up more than 11%. We're going to speak with the CEO of Pinterest later this hour. But coming up, Jordan Brooks, co-head of macro strategies at AQR, is joining us next on how he's navigating this period of uncertainty. And that's next in the Wall Street Beat. This is Bloomberg Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. President Trump floated an 80% tariff on China ahead of negotiations that'll start tomorrow in Switzerland. Trump is also urging Beijing to do more to open its markets to U.S. goods. Trump's comments are serving as a stark dose of reality to investors eager for any sign that he will seek an off-ramp to ease the trade war. British Airways owner AIG is announcing it is ordering the most planes ever, at least for wide-body jets, from Boeing and Airbus. The investment totals around $10 billion for IAG. The Boeing order marks a political win for President Trump. The administration teased the deal yesterday and tied it to its UK-US trade accord that it announced at the White House. And Sweetgreen is cutting its annual guidance as consumers cut back on those expensive salads. The company expects sales to be flat this year, down from a prior forecast of growth of 1% to 3%. The data underscores worries about a softening consumer. Fast food eateries like McDonald's, Wendy's, and Chipotle have all posted weaker results tied to the economic malaise, and they don't charge nearly as much for their products. Shonali?
Fascinating. I have been bringing in my salads lately as well, Matt. But we're going to switch gears. It's time now for the Wall Street Beat. AQR's long-short strategy is paying off, and the quant powerhouse was up over 12% in the first quarter in a low-risk strategy, and it's outperformed many other stock-focused hedge funds. Joining us now, Jordan Brooks, principal and co-head of the Macro Strategies Group at AQR Capital Management. My question is, you're not seeing a lot of double-digit returns here. I know that you're limited in what you could say about returns, but what is working under the hood?
Thanks for having me on, Shonali. Yeah, year, knock on wood, off to a pretty good start, and certainly a volatile macro backdrop, volatile macro market environment. A few things are clicking this year. I spend most of my time on the macro side. Our trend following strategies are off to a really good start. Both our broadest implementation that really trades all markets, as well as our what we call our alternative trend strategy, which focuses more on non-traditional alternative assets, things that are a little bit less correlated. Those strategies have really hummed since about 2022. We've had some good performance and some divergence from the space. And frankly, I think we're seeing some return on our research investments. We've pioneered a lot of new types of markets, whether it's trading long-short equity factors, whether it's trading things like alternative commodities or yield curve spreads in a trend-following program. And that's been very helpful. Multi-strategy portfolios where we do stock selection in addition to the macro stuff, those are really where we've seen the strongest performance, getting all that diversification.
You know, multi-strategy has been the flavor of the hedge fund industry for the last couple of years, but macro has been driving the picture this year. And that is where you really cut your teeth. Yep. When you look at the broader environment here, how would you suggest playing certain parts of the market, particularly the bond market?
Yeah, I mean, the macro backdrop is one that I'll call uncertainty on top of uncertainty. We were talking at the beginning of 2024, and I was talking about a highly uncertain macroeconomic backdrop, and look how that played out. We cycled, this is all pre-election, we cycled between a soft landing scenario, a hard landing scenario, persistent inflationary pressure scenario. Volatility starts spiking over the summer, and volatility has been high since then. This is all pre-election. You layer on top of that tariff uncertainty. You layer on top of that geopolitical risk. You layer on top of that a Federal Reserve, which, in sum and substance is saying stagflationary risks have risen pretty considerably, and you have a highly uncertain environment. Bonds could be part of the solution as part of a portfolio, but if you see renewed inflationary pressures, I wouldn't count on bonds to give you that diversification. I think the most important thing within bond markets, however, is really international diversification. Non-U.S. bonds, non-U.S. treasuries in particular, look pretty attractive. The catalysts are quite bullish: deteriorating growth, disinflation, central banks that are biased towards easing. U.S. catalysts for fixed income are a little more mixed. So international diversification.
Actually, so we were talking with Maria Waitman about this earlier from State Street, and she was saying there are problems here for U.S. Treasuries, but there aren't really pros in Europe for, say, bunds, right? I mean, the picture has changed here and not so much there. Even though they have, more spending, they're going to take on more debt with Chancellor Merz. It's more asymmetrical.
I think so. I think, it always makes sense to separate kind of a near-term outlook from a long-term fiscal picture. Obviously, deficit spending, by Germany is long-term bearish boons. You're spending more money, you're issuing more debt. But over the near-term picture, I look at where are the catalysts now and how are they likely to evolve? And I think when one looks at it that way, there is an asymmetry. Tariff uncertainty, the potential for higher tariffs, and they'll likely be higher than what they were. Okay, that's inflationary for the U.S. That's deflationary for our trading partners. Monetary policy here is, disinflation's been pretty disappointing, and monetary policy's wait and see. It's been more aggressive in other geographies. So I think there's a lot of near-term catalysts that favor international bond markets. How that plays out over the longer term, I think that's where these fiscal questions, that's where the status of the dollar as a reserve currency and all those other kind of longer-term picture questions come into play.
You mentioned you wouldn't necessarily count on bonds right now, and that U.S. bonds in particular. I should say you taught me how to bootstrap a yield curve. Not that I remember how to do it, frankly, but do you think that there is more risk to the U.S. bond market than meets the eye right now? If you were a betting man, where does the 10-year end up like next year?
Yeah, I think the outlook's fairly mixed for treasuries. I think there's a number of catalysts that could point towards significantly higher yields, and I think a lot of it depends on the resolution of tariff uncertainty. We're pointing towards a world in which we're going from tariff rates on an average basis that were probably in the low single digits to optimistically in the low teens, optimistically. That's a pretty large fiscal tightening. That is anti-growth. That is pro-inflation. I don't think you're going to see a Federal Reserve deliver the type of rate cuts that markets are anticipating if the inflation outlook continues to, to be muddled. And I think that could disappoint Treasury holders.
Give us a look under the hood at how you do business at AQR. Shonali knows this better than most, and as she alluded to, she studied this kind of finance. But I have no idea. When I hear quant fund, I imagine a whole bunch of math nerds typing algorithms into computers and setting the computers free to trade. How does it actually work? How do you trade?
You got the math nerd part right.
Yes.
So that you're on. In a nutshell, what we try to do is identify market inefficiencies. And then build, using quantitative tools, systematic investment processes to capitalize on those inefficiencies. And we're going to do that in stocks. We're going to do that in macro assets. We're going to do that in the corporate arbitrage space. That's what we do in a nutshell. And in a year like this, I do think, the common sense wisdom is to navigate a shifting macroeconomic landscape, you got to be the big discretionary managers taking very concentrated bets. Show me how many of those managers have gotten the Trump administration right. In an environment like this, I think a systematic quantitative process is very useful. We're all about diversification. Small bets based on a large breadth of indicators across a very large number of names. And discipline, it's kind of in our DNA. We follow the process. We don't say, hey, tear the book up, throw it out the window when you have a month like April. No, that's when we're sticking to the letter of our process. We're following our risk-managed approach, and we believe long-term in its efficacy.
Jordan, the long-short strategy succeeding in this environment was interesting for a lot of reasons. I'm curious about the short book, right? I mean, how much of that is driving returns, given what we've been seeing? We're in May, and we've seen multiple months of negative returns for the S&P 500.
Yeah, so we'll always be balanced in our market neutral strategies. So on the stock selection side, we're never taking a directional bet. We're taking, even from an industry perspective, small sector bets. We're really trying to maintain balance so that we can profit on relative mispricings across companies. On the macro side, we do make directional calls, right? A trend following strategy is unabashedly making a long or short decision in each individual market we trade. We've seen profits come from both sides of that over the course of, the year. And I think that's likely to persist. That sort of flexibility to get short markets that have negative catalysts. So maybe one thing I'll plug is I think it's an interesting approach to macro. Trend following managers suffered throughout the first quarter of the year. A lot of whipsawing, not much of a signal in markets. Our process, we look, in addition to price trends, at fundamental catalysts. That had you positioned bearish U.S. equity markets throughout most of the first quarter, bullish international markets, right? That long short played very well throughout most of the first quarter.
Dude, I learned so much. Obviously, you are a great teacher, so I really appreciate you coming in. Jordan Brooks there of AQR Capital Management. Really appreciate your time. Let's get a check on what's going on in the markets right now. We are about 52 minutes into the trading session right now, and we're looking at slight gains on the S&P 500. But this is really interesting because as we go into a weekend where the U.S. is going to sit down at a table with China in Geneva, you might expect more optimistic bets, and we're not seeing that play out. The NASDAQ up 0.3%. Of the U.S. Treasury yield right now down about 3 basis points at 435. This is Open Interest.